Year-end tax planning 2018 is what we're going to talk about here today, my friends. So part 2 of our series on year-end tax planning. So listen up because we got a lot to discuss and we're just getting the ball running. Like I said last time, man, I love this part of financial planning because this is when you got some creativity to start looking at various things that are on your mind. So last time we talked about just looking at your AGI and your taxable income. Remember, your AGI is $100,000. If you're married filing jointly, you'll just say I'm 48, my wife's 44. We have $24,000 standard deductions. Thus, we have taxable income, not $100,000, $76,000. $100,000 is our AGI. $24,000 is our standard deduction. $76,000 is our taxable income, which puts us in the 12% tax bracket. You got to understand that. Now, Georgia is not very tax friendly for working status. For retirees, it's wonderful. All right, so we talked about that. So go back to that last video and watch. Now, we talked yesterday, too, about the huge capital gain distributions that are coming for various mutual fund companies. So I'll do a video on Fidelity specifically. We hit on Fidelity yesterday some, but I'll just do one solely on them. We talked about Vanguard. We've talked about American funds. And so you can see there's going to be big long-term capital gain distributions, short-term capital gain distributions, and dividends are coming out as well. Now I just want the old tried and true, which is called tax loss harvesting. This is old, tried, and true. And what that simply means is you sell your positions that have a loss to lock in your losses, because the losses are an asset, believe it or not, and they don't transfer at your death, okay? Because what happens with a step up in basis, if you have a $100 share price, you die when it's worth $200, your heirs receive it at $200. If you have $100 where you cost your basis and you die when it's $50, your heirs receive it at $50. That's a step up, going up, but it also steps down. So your basis goes up at your date of death or it goes down. Whatever your date of death is what the basis of the inherited property is. So tax loss harvesting is a way that you can take advantage of the tax code. You have a way to take advantage of the tax code in order to lock in losses that you can use to offset other gains. It's the simplest thing, trick in the trade, but it gets overlooked a lot, and it should not. So let's talk about this. I bought a stock for $100 or a mutual fund, all right? So my basis is $100. If the stock goes up to $200, what's my unrealized gain? Oops. That's gain. Ugly. Well, that's $100. All right. So I bought it for $100. My basis, cost basis, is trading at $100, which means I have a $100 unrealized gain. And that just means if I sold that, I'll have a taxable gain of $100. And if I've had it for over a year, it'd be taxed as long-term capital gain, 0, 15, 20, or 23.8, depending on where you fall in the tax code. Now, let's say I bought a stock for $100, all right, and it paid a $10 dividend. So what's my cost basis? Well, my cost basis is 1 plus that. All right, so now I go on the website and it says it's worth 100. It's trading at 105 right now. That's what's trading at. So what's my base? What's my gain or loss? Well, I have a loss of $5, even though it's actually trading at more than what I purchased it for. All right, so I have a loss of $5. And the reason is because that $10 gain goes to increase my cost basis. So I paid twice. I paid the $100 initial proceeds plus the $5 or $10 of dividends, which I pay tax on that. The two combined is a cost basis of $110. So now it's trading at 105. I have a $5 loss. Should I sell that? Well, I don't know. But remember, if you sell that, you're going to lock in a $5 loss, which could be used. So now let's say we do sell this. All right, you with me? So we sell 105, $5 loss. But we also have a position that we sold for 105 that was at 100, $5 gain. So I have 0 capital gains. All right, because I sold a losing position. It could be a mutual fund, could be a stock, could be ETF. And I'm using the loss to offset a gain in something else. And maybe I'm selling the thing for a gain because I'm worried about it. I mean, it could be any myriad reasons. I need some liquidity next year. I'm worried about it. The CEO just became a crack fiend. I mean, you name it, it could be anything that you want to move on from that position. Maybe you just have a say, you said after 20% ride, I'm going to get out of it. I don't know, whatever it is. But I'm selling it for a gain, but I hate to have to pay tax on that gain because that could affect my income for other things as well, Social Security, Medicare, the whole thing. So I'm going to sell it for a gain, but I'm going to also sell my other position, even though I bought it for 100 and it's trading at 105, because I have the dividend in there, I'm actually have a $5 loss. So I'll sell that and that will be a break even. All right, but now let's just say you're concerned about, I don't know, Jeffrey Bezos becomes a New York Yankees fan. You're like, man, I can't stand the Yankees. Jeffrey Bezos lost his mind. So I bought Amazon for 100, and it went to 115, but now down to 85. That's my basis. Went to 115, but now it's down to 85. When it went to 115, I didn't do anything. It sat on it. Now it's at 85. What's my gain or loss here today? Well, this right here is meaningless. It doesn't mean anything what it went to. And I hear that all the time. Back in 2000, I was a multimillionaire 20 times over. It doesn't matter. All that matters is what you bought it at and what it is now. And Amazon doesn't pay a dividend, so that is not going to have any dividends to go add to your cost basis. So we know for a fact right now, you got $15 loss in that guy. And maybe you're concerned with Amazon because, like I said, Jeff Bezos became a New York Yankees fan. You're like, that's just crazy talk. The guy's obviously lost his mind. Can't have a Yankees as a CEO of the Amazon. Oh, my goodness. The dude lives in D.C., for heaven's sake. He owns the Washington Post, so he's got to be a Washington Nationals fan. I don't know. But you're saying, so I'm going to lock in that $15 loss. I'm going to get away from Amazon. What else can I do with that $15 loss? Well, I can't write the whole thing off of my taxes. I have no other gains to offset it with, but I can write $3,000 off. Interesting. So what could we use that $3,000? So I have a $15 loss. We'll just say 15,000 losses, which carries over. Now, you ready? This is where it gets fun. We'll say I have $103,000 of AGI. All right, minus my $24,000 of deductions. That puts me at $79,000, which does what, my friends? That puts me in the 22% bracket. But I have a $15,000 loss in there. I can't take the whole 15, but I can take 3,000. Which puts me at the $76,000 taxable income, 12% bracket. Now, people say, well, that doesn't do that much, Josh. The difference between 12 and 22 is only a marginal tax rate, so it's not like you're paying 22% on the entirety of the $79,000 and 12% on the entirety of the $76,000. Oh, my friends, are there other things? This is just an example. Are there other things with a 12% tax bracket could be beneficial to you? Well, yes, there is. What if part of this $103,000 was in capital gains? Because remember, if you're in a 12% capital gain, you pay 12% tax bracket, your capital gains are nothing. All right, so if you have an extra $3,000 you can write off, that again reduces your taxable income down to the 12% bracket. So it could be worth more than just a simple writing $3,000 off here. It could be other things, ordinary income, qualified dividends, long-term capital gains. It could be a myriad of other things. I don't know what it could be. You'd have to look at it for sure. Maybe your state has some certain specifics. Or maybe you live in one of these states like Rhode Island. The minute you go above $100,000, you're in a significantly higher tax bracket, or New Jersey, than if you're under $100,000 if you're married filing jointly. Now, off the top of my head, I don't remember specifics. I just remember Rhode Island had $100,000 where your 401k is not taxed and your IRA is. So either way, at the end of the day, that $3,000 can be carried forward to offset other types of income that could have ramifications of other aspects of your income. Again, Rhode Island, $100,000 if you're married filing jointly in Rhode Island. It's $100,000 if you have less than $100,000 of AGI, I think, or is it? I can't remember. But anyway, it's less than $100,000 you get your 401k distributions are tax-free. And in Maryland, I can't remember this. I think it's 60. I can't remember. But Maryland, we just don't want IRA distributions. 401k distributions are much more beneficial. TSP as well. IRA distributions are not. Can't remember the specifics, but I do know if I have a $15,000 loss and I haven't actually pulled the trigger on taking that loss, then guess what? I can't use that. It's just a paper loss. I want to turn it from a paper loss to a real loss that I can carry forward or at least use it this year to offset some other gains or taxes that I have as well. And I think a lot of people miss that. So I say, so remember, the stock market doesn't care what you think about the stock. The stock market doesn't care what you purchase the stock at. The stock market just says, this is what it's worth today. It literally doesn't matter. The market does not care if you have a $15,000 loss or a $15,000 gain. It doesn't know. Why? Because it's inanimate. It doesn't know, doesn't care. It doesn't care about you, doesn't care about me. It just is. I cannot stress this enough. So people say, well, I'm going to hold off on selling it until it goes back to a break even. Market doesn't care. There's no way at all to know if you're going to break even or lose more. So why not just take this? So if you're only holding on to it because you're at a loss, you're like, I'm just going to hold on to it so I can break even. That's just emotional. That's just psychological. And that's just not good investing. That's just it's painful for me to take a loss. Lots of studies, my friends, that say you cut your losers and you ride your winners. And cutting your losers, like in this case, is a wonderful mechanism to do that. I am not saying go sell your losers. I'm saying I'm leaving it up to you to determine that. But if the whole point is I'm down so much, might as well just hold on to it to come back even, that doesn't make any sense, because that means you're wasting your losses that can be used for other things. Again, it can write off at least $3,000 of ordinary income. It can be used to offset other gains. If you're sitting on a loss and you're just hoping for it to come back to break even, and you're going to sell other stuff at a gain, or even worse, you have mutual funds. Mutual funds that pay you a dividend that would be, or a capital gain that would be taxed to you, and you're sitting on a big loss just hoping to break even. That's absolutely the worst financial plan there could possibly be. Let me just real quick show you again. Mutual funds. I'll do this till I'm blue in the face. I did this the other day. I just got to do it again. Mutual fund. You bought it for $100,000. That's a $10,000 dividend. That means your cost basis is $110,000. All right, that's what your cost basis is. But the market price is down to $90,000. So you bought it for $100, you got a $10,000 dividend, you have $110 as your cost basis. Market price is $90,000. You have a $20,000 loss. This right here, though, is taxable to you as capital gains or dividends, whatever the distribution is. Even though it went down in value from 1 to 90, 100 to 90, you have 10% decline in the value of the holding that you have. This distribution is still taxable to you even if you have a decline in your amount. If that is long-term capital gain and you're sitting on this and you did not pull the trigger to sell it, you're going to pay tax on this even though your account is valued at 10% less than what you bought it on. You're going to pay tax on that if it's long-term capital gain, even though you have a $10,000 capital loss at this stage. This, on the other hand, if you would have sold that and got rid of it, this can be used to offset that. I know it's pretty, isn't it? But that's what I'm saying. Why sit on a losing proposition if you're going to get distribution sent to you when the market is going down right now, as we're seeing anyway in the last month, or down, 5 or 6%. So sell your losses and take them. Lock them in for future use. Do not be an investor who says, I'm going to sit on it until I get back to even. Because the market doesn't know or care what your break even is. It does not care. Thus, you should not care. The question that comes to investors is, would you buy that same position today if you have the cash? And if the answer is no, then sell this thing. It doesn't matter what you've done. It's already water on the bridge. Always ask yourself this as you're looking at your portfolio. Would you buy that holding today, in hindsight, if you could redo this? If I said, here's $100,000, would you buy that holding that you have today? If the answer is no, then you need to sell. There's no other way around that. If the answer is yes, then hold it. That's fine. But that's what it comes down to. Would you do the same thing today, knowing what you know now as you did before? And again, if the answer is no, sell it and lock in the gain. Lastly, at your death, lock in the loss, at your death, that loss does not follow you. It doesn't. So you've essentially given your kid or your heir or your spouse a portfolio that's less in value than what you paid for it, where you could have sold it and used that loss to offset other income. I know it's kind of long-winded there, but it's important to look at your statement See what it looks like. This is our non-IRA accounts, by the way. Non-IRA accounts. These are taxable accounts. What are the losses in there? What are the gains? Can we work them against each other? Can we take a loss to offset future gains? Because this stock I have now I like, but if, as I put a limit on there or something like that, and I think the stock could go here, but it goes down here instead, I might want to liquidate it. I have a pretty good big gain in there, but I can use some of my losses. That's called tax loss harvesting. The oldest game in the book about just basic financial planning 101, investment planning. Really, this is just straight up investment planning. Take them. Now, there's lots of studies that say taking tax loss harvesting doesn't really do that much, blah, blah, blah. I frankly don't care, because at the end of the day, if I have this $15,000 loss I can bank against future earnings, that makes it a lot more nimble when it comes to liquidating other accounts that might have gone a little bit beyond where I thought, or I might have other sources of income that I wasn't expecting, or the tax laws are different because of Rhode Island or Maryland or California when it comes to my gross income and taxable income. And if I can use these off it, I want to. So hope this helps. Tax loss harvest, you got to do it by year end. January 1st, doesn't matter. It's got to be December 31st. Tax loss harvesting. Look at it, look at your statement, and act accordingly. And we'll see you next time. Thanks, guys.